Hi everybody, it is James coming at you from Pivot Point Trading. Has been a little bit of time once again since my last public video here on YouTube. In fact, what I recently just came across was a little notepad that I keep in regard to some what I find to be interesting market data. I believe the last video that I put out, or at least released, was that of, I guess, the markets from a standpoint of market uniformity or a lack thereof at that particular point. I think this was at some point in August. Neither, right, the equal weight S&P 500, the New York Composite Index, the Dow Industrials, the transports, the utilities, nor the Russell 2000 had confirmed that of the new high in the S&P 500 index, nor that of the Nasdaq, right? Making, and I made the distinction at least, that it was a very similar parallel to what we had seen back in the 1st of September 2000 and also the 9th of October 2007. First of all, I would encourage you to have a look at both of those dates again, 1st of September 2000 and the 9th of October 2007, that phenom last arose. Obviously, a lot has changed within the past, I'd say 1.5 months that I left you with that call. Also, I just wanted to point out, as I jot through some of these past notes that I've made, the Nasdaq, right? It's up 48%, if not more, through to the September high on the 2nd. It's up over 48% in that year alone, while earnings had dropped over 30%. Apple, this was pretty interesting one too, was at one point 1%, if not, I think it actually took it out, right? The entire market cap of Apple was, or at least it had, surpassed that of the entire market cap of the Russell 2000. Let that sink in. Apple alone surpassed the entire market cap of the Russell 2000. Now Apple, at this particular point, as I sit down and give you this recording as at Saturday, right? Apple's down over 20% from its recent highs. What else do we have? The S&P beating its equal weight version by the most in a month since the year 2000. That was back in August as well. I could go on. We've seen a lot of very interesting sort of signals, or at least past signals set up. This was all leading to the blow off top that we saw back on really the second trading session in the month of September. Interestingly enough, what I can do is just very quickly jump into the Nasdaq 100. I think this is quite appropriate at this particular point. I'm going to bring up the Bollinger Bands for you, and let me just take the annotations off my screen again. I'm just going to rattle through some interesting charts on the US markets at this particular point. But you can see if I just zoom on out and show you what's going on in the Nasdaq, this is obviously, right, a parabolic move. It's very similar to what we saw in the year 2000. What we've achieved over the past 4 or so months is continuous series of monthly closes above that of the Bollinger Band, right? All the way through to the period of August over here, whereby it looked as though we were entering into a rocket ship and this thing was just going to go purely vertical, right? What we've achieved so far in the period of September, right through to the current juncture, is that we have now, I'll just ask you the question, what is this monthly candlestick under construction? I know there's still another 2 or so weeks left in the month of September, but the answer technically is an outside engulfing monthly candle. It is very similar, if not more bearish than that of a tweeze, a top reversal. And this is pushing, again, a number of standard deviations outside of this top Bollinger Band. The last time we saw a record series of closes like we have achieved all the way through to the period ending August was back in the year 2000, right? So, and generally what happens, by the way, just so you know, and so it's not as if no one told you, what happens is that once you actually close back inside the band, once, of course, the mania itself pitters out and ultimately falls in on itself, is that at a very minimal target, not here to really shock anyone, the midpoint of the Bollinger Band itself, which is again the midpoint of the top and the lower band, will act as support. It generally will rocket towards that. We are trading up here at 11,400 points. The lower, or at least the mid band of that, is 8,833 points. But beyond that, what happens is when you enter into bear market territory, right, once you do interact with the midpoint of the Bollinger Bands, which are, again, separating, ushering in volatility, what happens is you come down and you ultimately tag the lower Bollinger Band itself. Right now, that's coming in actually below 6,000 points, which is, well, if you take the 12,000 top, it's 50% from that August price that we actually pushed at or closed at as at the end of August. Generally what happens too is that you don't just tag the lower Bollinger Band, you actually do it a couple more times at lower prices. So again, this is sitting at 6,000 points. Who knows where that lower Bollinger Band is going to end up? But it's not only privy to the Nasdaq 100, right? If I just put this back on, this is very interesting too, just to look at this a different way. Since the compression lows in March, that sort of stabilized at 7,000 points. We've run on up to 12,500. We have been largely contained below, or at least above that of the lower support channel here, and also the upper resistance point as well, up until the point whereby we tagged that top band one final time. What's concerning about this is that, yes, we came back down to support. However, we have overshot it. And really over the past 1.5 weeks, we have been stabilizing not above the support area, but actually below it, which is something to focus on. Now, when we start looking at other individual indices themselves, there are some beauties out there. First of all, I'll start with the financials, right? Because again, when you go back to that video, and I'd encourage you to do so, we were talking about the uniformity or lack thereof of indice uniformity, right? No other markets were confirming that of the Nasdaq 100 nor the Nasdaq itself. And we made a very clear distinction that the financials, they were nowhere near participating in this exuberance that the technicals, or at least technology, right, was showing us. In fact, what we spoke about was the discrepancy, the bifurcation, the divergence between the financials and that of tech. And if you look at XLF at this particular point, let me flick on over into the weekly chart. You can see very clearly here that if I change this to a line chart, right, these past bullish trend lines are very important, because what you need to take note of is, well, what happens when you break them? Generally, you get down, you'll come back up, you'll tag them, right? This is the return to normal until ultimately the bear market is ushered in. Well, if you go from 2009 and have a look at this all the way through to 2020 more recently, this is February, March lows over here. We've come back on up. This is a closing line price of the weekly. So again, it just takes out the noise of it. We've overshot, right, this past bullish trend line. We've poked our head above it a couple of times. However, it really seems to be rolling. I'll put this back into clearer vision with the candlesticks. You can see here, this was the June exuberance in equities, right? Prior to a little correction that equities as a whole took. But since then, as the Nasdaq has continued, and really only the Nasdaq, and to a lesser extent the S&P equal weighted index, you can see here the financials are actually rolling over. This is very interesting to point out. If I show you this on the 200-day simple moving average, you've got a series of lower highs. When we have a look at this on a weekly candlestick, a weekly chart here, using the 50 and the 200-day period as support and resistance on the chart, you can see here, if I zoom on in very, very quickly, we've come on up, we've tagged the 50-day. But what's very important to point out is that this 50-day is very close to crossing below that of its 200-day, right, simple moving average. Now, if I go back and show you the last time that this occurred, right, it got close somewhat in 2016, but the last time we saw this signal, again, was when we got the rally, the back test, and just after the beginning of the sell-off, which really began in late 2007, which again didn't conclude until the very early period. I think it was March 9th, 2009, where we got this definitive cross. What we're doing is we're hanging out below these moving averages. Big distinction to make. We're not above it. It's not as if we flinch below it. Now we're back above it. We've actually been grinding higher towards it, and this is working in combination with the back test of the primary trend line, which has been in effect since 2009. Again, just pointing out the big divergence here is that, yes, they were creating, right, fresh new all-time highs in the period of January, February. However, have a look at the space between the financials, where they were in February and where they are right now as at September. If I show you this too, when it comes to the monthly MACD signals, this is what we use for transitional tops, right? Macro bull to bear markets, what we achieved in 17-18, right? This was the peak of global growth. We established a new all-time high at that particular point. We actually rallied late into 2019, early 2020, pre-COVID. But what we failed to achieve was any confirmation on the MACD itself. This is what we call divergence, or otherwise known as negative divergence. And as you can see, as we've rebounded back on up, it's really just a resting pattern on the MACD prior to it continuing to roll over. The RSI, big distinction to make is that generally during bull markets, it holds above the 50 point. Now it actually finds resistance at the 50 point, which is exactly what XLF is doing. You can also extend this, by the way, into BKX as well, which is the bank index. If I can bring up this chart too, very similar pattern or a very similar theme. You can see once these trend lines are broken, they will generally act as resistance, and it does usher in, right, a larger, right, retracement in the world of equity prices. You can see this actually peaked in 18, it got close in 19, 20, it didn't actually achieve it, but we definitively moved below it. And as such, when I show you those similar moving averages again on the weeklies, you can see the 50 below the 200, and this is just simply calling with some very short-term support, like a little rising support line, which again is just looking to be broken if in fact we do see any legs to the sell-off that we're currently in. Now, also something to point out too is that the S&P 500, although again it briefly confirmed that of the Nasdaq, right, composite index pushing to new all-time highs, one thing it didn't, or at least it wasn't confirmed by, was by the equal weighted S&P 500. That never got to new all-time highs. It didn't even get close, and in fact, although we did poke our head above, right, the February high over here, we're actually back down below it. Right, so we were above it for a total of no longer than a week, and we've just been clobbered below it. In fact, when I start showing you this on the exponentials, they're starting to move sideways. The 10 is crossing the 20. If I show you this also on the Russell 2000, you can see moving sideways. Everything's essentially moving sideways. When you start looking at this on larger fractals as well, and again, I'm running through this very, very quickly. You can see these decelerating fan lines on my screen, 1, 2, 3, and 4. But very importantly, you can see this downward sloping resistance area, right? We've got the high in 18, we've got the lower high in 1920. That was 2019, 2020. And here we are at the current juncture, still a long ways below where we were, and also seeming to backtest this fourth decelerating fan line. So you've got the financials that aren't participating in any V-shaped recovery. You've got tech, which is outperformed, just really in earnings multiples. That's really the only growth that we've seen, or the reason for this. But what you're seeing here again is the breakdown of past trend lines coming true again, right? It's not there on all of the markets yet. Some are more advanced than others, but you can see it here as I go through the Russell 2000. You can look at IWM as well if you wanted to look at a tradable scenario on that index itself, if you wanted exposure to that. When I flick on over into the New York Composite Index, again, we've got the peak over here in 2019, early 2020. You've got the bull line in effect since 2009, which has been in effect right through to the breaking of that. And essentially since then, this is the back test of that line that is underway. It's been underway for 4 or 5 months. Have a look at the volume. Volume's trailing off. This is coiling, right? Just above the simple moving averages, which I think a lot of people are looking at. Novice people saying, oh, this is a good time to buy, right? In the overall markets, and they're just positioning themselves for, I think, follow through to the downside. And we're going to have to monitor that as it plays out. But again, almost to the penny as well, you've got the Dow Jones Industrial Average coming, or at least coming back and up to close that open window, which was the beginning of the waterfall sell-off in the month of March. We pretty much tagged it to the penny. My target up here was 28.923. I didn't participate in this whatsoever. But since we've closed this window here, not only have we seen a rejection off from this area, but we've broken that of what appears to be an intermediate trend line as well. So we're stalling out below the all-time highs, but finding rejection at the final open windows. You can see we've got gravestone doji, so to speak, on Wednesday. We've got a nice support area here, which is for, and in many respects, the neckline of either double tops, head and shoulders patterns, or either triple tops as well. A good example of that is this pseudo pattern showing up on XLF on the right shoulder. Another great example of this is the Russell 2000. You can see this double top. What we're doing right now is back testing the neckline just there. And this is taking place across all of the market indices. Okay, not to mention, of course, the individual shares that we follow as well. So again, complacency is all over the place. The more I look at markets, the more I read about markets, the more I gauge even sentiment myself. In regard to markets, in fact, it wasn't all that long ago where we saw the put to call ratio at its most extreme. This was highlighted on this date over here. This was the 16th of July. That even got more distorted the closer we got to the all-time high over here earlier in this month too. So again, outside of this, see this vertical line on my screen? The first vertical line over here was to see the market up over 1% at a fresh all-time high, but closing down 2%. Now, this is on the Nasdaq Composite Index. If I just zoom on out and show you this, if I go to a monthly chart and show you the only other times we've registered those two phenoms, so to speak, is over here, the first line, and I can show you it actually to the day. And I know it's not going to align perfectly going back, but again, it just shows you a bull mark sort of figure or territory as to where we are in this sort of late market cycle. You can see over here, and again, it's pretty close, isn't it? Whereby it continued for, you could say, only really 3 more sessions. It did find a dip. It did try and take out its all-time high. It failed, and then the rest is sort of history after that. We moved sideways for quite some time. This is where the put to call ratio, right, gets us extremely lopsided on the bullish side, or at least on the call side of it, right up until the point where it crafts that right shoulder, and then it begins to take out and continue into the bear market of 2000. The reason I'm showing you this too is because if I flick on over into some charts that I've created on stock charts over here, I'm playing around with different yield spreads or different mixes. You've got the 10 and the 2 year, you've got the 10 and the 1 year. If I go down and overlay this, the 10 year with the 3-month treasury over here, what you're going to find is that, look, during an actual recovery, or what is that of a bull market, what happens is you see these spreads, they'll begin to flatten, or at least they'll flatten over time up until a point whereby the spread itself, it inverts, right? So it inverted back in the year 2000, 2001. Leading into the GFC, or at least the peak over here, it inverted very briefly in 2006, but you started to see the real inversion towards, I guess, late 2006 into early 2007. And again, more recently, right, and this is very important for you to understand, back in 2019, we started to see it in the month of August. And since then, yes, it carried on earlier into, I think, January of 2020. But what you're starting to see here, what I've done is I've overlaid the Bollinger Bands with this. We're using a 2 standard deviation push or a thrust. And what you need to take note of is that after the inversion, what you want to look for is these histogram bars taking out the previous highs and pushing into the top of this Bollinger Band, right? And we are right on the cusp of doing this. In fact, we're about to take out, or very close to taking out, the closing print or the spread that we actually achieved in the month of August. And you can see this is sort of like the TNT on the actual equity market at this particular point. You can see the spread closing here between the 10-year and the 3-month. It's sitting at 0.6. If this gets anywhere close to, say, 0.78 or even 0.80, which is really only 20 basis points away from where we're currently trading at, I know there's 2 months left in the market itself. You can see what happens when they begin to steepen again. That's where the damage is done. So you can see just how close we are historically to this connection, or at least this relationship playing out. And I just think it's worthy of your attention. Another way of looking at it is when you begin to see yield steepen again, or at least the spread steepen, you can have a look at the divergences between where the equity market is in past cycles and where we are more recently once we inverted below zero on the y-axis of my chart over here. That's not an X, that's meant to read Y. But you can see right here, if you extrapolate this, you're looking at a 144 spread, percentage spread there. It got bigger in the year 2007, 2008. It got out to over 200%. The spread that I'm looking at particularly right now is closer to 500%. That puts this at a 2.5 push above what we were seeing back in 2007, 2008. And that's really what has the Fed concerned at this particular point. So pay attention to these spreads. We recapped them over the weekend. Actually, I just recapped them about an hour or two ago in that pro analysis class. I know I haven't been all that public, so to speak, in analysis. That class is thriving, by the way, in pro. And I thought I'd just share some of the updates that's taking place in the equity markets themselves, because again, as I look around, you have a look at the sort of the retail call buying. They're doing everything technically wrong. Think about it. Again, in the world of options, a lot of people are just beginning to sort of scratch the surface of options trading, but really just in a nutshell, right? Any option contract, there's a buyer and there's also a seller, right? And what I'm seeing is that a lot of these sort of Robinhood accounts or novice traders, yes, they're interested on the call side. Again, I still deem that number one to be the wrong directional play at this particular point, but hey, everyone will gravitate around calls or two calls when they think stocks only go up, right? But also on that, between the buyer and the seller, B for buyer, S for seller, you have to think about the actual strategic importance of whether you are a buyer and a seller and the maturity of the actual option contract itself. Think about it. What these novice traders are doing, they're buying, first of all, the calls, which are on the wrong directional side, but they're also trading weeklies, which is just dumb. The reason for that is because it doesn't give them a lot of time for those trades to actually push into the money, or to really, sometimes it can be obscenely, the return on those calls or puts for that matter can be just generally obscene. But generally what you want to do is you want to buy additional time and you want to buy intrinsic value. Intrinsic value is the portion of the option contract that doesn't actually erode over time. So if you're a strategic long-term, investor or just trader in general, you should be pushing out the expiration of those contracts at an absolute minimum 2 to 3 months into the future, right? Because the risk essentially is borne on the option seller. The seller or the writer of the option is really just, or at least the buyer is transferring most of the risk, if not all of it, to the option seller over time, right? So these novice traders, they're buying weekly call options, one in the wrong direction with absolutely no time to option expiration. And that's just the perfect recipe for smart money institutional option writers to actually write those contracts, right? So they'll be enacting the contracts with the buyer, who are the retail investors, and they're doing it on a weekly time frame because they're clipping all the, obviously, the premium up front, and then come Friday or Thursday, the options just expires worthless. So they've got it all backwards, all of these new option traders or investors, whatever they want to call themselves, on two fronts, which is going to be disastrous if, in fact, right, just to sort of conclude all of this, again, it goes into much more detail over in the weekend class, which is up on the website. But if you look at it, right, this has worked out well as the 50 has been respected. At the moment, it's starting to be violated, and it's a big distinction to make. Have a look at the Nasdaq. We've got multiple tags of the 50. Yes, we have a lower wick, but we're actually closing below it for the third time in the space of about 2 weeks. If I show you this on the Dow Jones, it's just above it. The New York Composite, it's just above it. Have a look at the Russell, right? Just above it. The S&P 500 closing below it. In fact, it's closed below. This is the third week now that the S&P has been negative. I know, albeit immaterially at this point, but we're starting to violate these 50 exponentially weighted moving averages. In fact, the 10 is now crossing below the 20. And again, to recap, they're all moving sideways. So again, they're playing with fire doing these strategies. If in fact these 50s give out and these larger fractals work, again, wink, wink, if I show you some of the connections on the weekly charts of the 50 and the 200 week, and this might be a good way to surmise this. I could go on, but if you look at the Russell 2000 or the IWM, what we've just achieved more recently, I know it's weighted based on the March meltdown, but we've seen the 50 cross the 200. The last time that occurred was again back in 2000 and 2008 over here. So again, we'll see how much of this is just because of the price action that we saw in the period of February and March. But really anything to take away from this video is that the financials, they're certainly not participating in this rally. They haven't participated in this rally since essentially May. Think about that. I mean, we're pretty much trading at the prices where we were on the financials as to where we were back in the period of May. There is a huge disconnects that we haven't seen since those two time periods that I've just given you. As I just flick back through my notepad again, I'll give them to you one final time. If you missed them, I think it was it October 2007, I think it was. And yeah, it was too. It was the 9th of October 2007 and also the 1st of September 2000, where we started to see relationships and similarities, parallels between the market at both of those occasions. You can see the entire bond market with the spreads that I just showed you in a couple of moments ago. And really anything, if this party is really going to get started, so to speak, if we're going to see any traction whatsoever on the downside, you're going to see it play out here first, right? 2408 on XLF. Again, if you wanted to sort of extrapolate this or look at it into the banking index itself, if I can just switch on over it, let me just bring up my keyboard here and flick it up, $BKX. The bank index is very similar to XLF. You can see we're below the 100, below the 200. That's all pretty elementary at this point. But if I can just show you this here, it's going to come in sit in at about 72.52. Have a look at the option chain on that. I think you're going to be pleasantly surprised to see the open interest, right, on the put side, the right-hand column. I think it's going to shock a lot of people as to how the institutions are actually not investing but hedging what's about to happen in the equity markets. All right, so that'll do. You may have just seen a blow of parabolic top or at least for this market cycle, ending on, if I can just bring it up here, the 3rd of September, it looks like, the 2nd of September, in fact, 2020. So time will tell, but I hope you appreciate that update. Again, you can find me in class. It's recorded class up on the website. I'd encourage you to do so. And now more so than ever is not the time to be jumping into the market and buying, in my opinion. All the best, everyone. James signing off on behalf of Pivot Point Trading. Farewell.